Yeah. So, can you hear me? Good evening, everyone.
Good evening, sir.
Okay. Yeah. Okay. So, we'll wait for another 2 minutes and then I'll start. Okay, so in last class we saw whether we need to finance the asset with the debt or we need to take the asset on a lease. Okay, that evaluation we did it and we decided where the present value of cash outflow is less, that option we need to consider. Okay, so instead of debt, if we go with the lease, then what would be the impact on the financial statement? Okay, so what happened if you take a debt? So it will impacted on your debt equity ratio. Okay, as well as interest coverage ratio. Clear? Okay, so as we know, means if you take a debt, then you need to pay the interest, so your interest amount will increase. And because of that reason, okay, so interest coverage ratio get increased. Okay, so if denominator, in numerator we generally kept the interest amount, and in denominator it is EBIT. Okay, earning before interest and taxes. So if interest amount increases, okay, so your interest coverage ratio will also increase. Will increase. Okay, on a asset on a lease. Okay, so here lease is basically two type. One is finance lease and one is operating lease. Okay, so I don't know you are aware or not, but finance lease we generally treat more as a debt. Okay, in operating lease, so if you take the asset on a finance lease, so it is the more or less similar impact on I mean whatever if we take on a debt. Okay, so, but if we take on an operating lease, then the financial ratios may it will not affect existing debt equity ratio, not affect. Okay, and plus because it is an EBIT, so to some extent interest because it is a part of it will reduce EBIT. Okay, so to some extent it affect the interest coverage ratio. So that is basically the impact on the financial statement. Okay, just keep in mind. If it is a financial lease, then it is we need to treat this as per the accounting standard. We need to treat it as a debt. Okay, so it is again impacted to the debt equity ratio. It is considered as a non-current liability, current liability and non-current liability. Okay, but if it is an operating lease, so it is not considered as a debt, but like interest coverage ratio get affected because because of operating lease your EBIT get reduced. Now IRR, internal rate of return. So it is basically IRR is the rate of return, okay, where NPV is 0, net present value is 0. That is basically the IRR. Okay. Okay, so here they have not given the any example. Okay, how to calculate. I'll show one method actually here. See, if there is a like year 1, year 2, year 3, year 4 and year 5, year 0, here basically the cash flow is minus 2 lakh and then 20,000, 40,000, 80,000, 70,000 and 1,20,000. Okay, so you have this project where this is basically the cash flow, separate cash flow for like 5 years. Okay, so first we will see how we are going to calculate the IRR and then we discuss all those points. Okay, just keep in mind IRR is basically the rate of return if we discount like the cash flow with the rate of return where the NPV is 0. That is basically the IRR. So I consider first 15% as a discounting rate. Okay, so here it is 1, then 1 divided by 1.15. I think everybody is aware why I'm doing this, to calculate the NPV at 15%. So it is 77 negative. Okay. NPV at 15%. Clear? If I calculate the NPV at 10%, okay, can anyone judge whether the number is net present value is positive or negative? Before calculation, I mean, so that I can understand whether you are able to really understand the concept of NPV. You can guess even. Any guess? If like I calculate the NPV at 10%, so the what would be the impact on net present value? whether it is more than 15% or more than 10%. Any guess? Either it is more than or less than. You can guess even. See, keep in mind, just to understand again, if I consider the discounting rate at 15%, that means I am expecting higher income. I mean here instead of 10%. Okay, so I'm expecting higher income. Okay, so it will give a less present value. If you increase the discount rate, your present value goes down. Keep in mind, because the means whatever may be the present value, this is after considering the return of 15%. Okay, if you are expecting higher return, then your present value goes down. Okay, so if I apply this concept, means if I calculate at 15%, I got the negative number, and then if I'm calculating at 10%, that means I will get the higher present value because I'm discounting at a lesser rate of return. Clear? So again, I'll find out the discounting factor at 10%. Okay. So here present value is 55,922. Just a minute. If I discount, I think it is, yeah. So I took a wrong number. That's why it happened. So it is positive. Clear? Okay. So if I calculate at 15%, it is minus. If I calculate at 10%, it is plus. Okay. So somewhere like my IRR is between 15 to 10. Okay. And very near to 15. So it may be the 14.5 or something like that. Okay. Now how I am going to calculate. Okay. So I'll just write NPV at 10%, which is 33,666. Okay, and NPV at 15%, which is minus 78. Okay, now I want to calculate. It is very near to 15% actually. Minus 78 is almost zero, so we can predict easily. Actually, I need to calculate with a 14%. Okay, so okay, let it be. Okay, so now if I want to calculate the IRR, okay, so if I mean even if it is plus, even though it is not a matter, now you can understand IRR equals to, like I'll start with the NPV first, so it is 10% plus, okay, so 33,666 divided by average 33,666 minus 78 multiplied by 15 minus 10%. Okay, so what is this? This is IRR NPV rate 1. This is NPV 1. This is NPV 1. This is NPV 2. Then NPV 2 minus NPV 1. Okay, so again 10% plus now 33,666 divided by 33,666 plus minus minus plus 78. Okay, and then okay, I'll keep 0.99 and here 5. Okay, and if I multiply, so it is slightly less, 4.98. Okay, and 10, then 10% plus 4.98. Okay, so it is 14.98 is my IRR. Okay, so I think we need to take like if I consider the 20%, this is 27 and here. So we can test as 20 and 10 even. Okay, so it is 27. Like first, like we start with 10%. Okay, then 33,666 divide by 33,666 minus minus plus 22,276. Okay, multiplied by, I'll calculate here, 10%. Okay, so it is 0.60. So it is 10.06. No, 10%. Okay, 6%. So 16.08. No, somewhere some error is there. 20 minus 10, 16.01. It should be 14.98 actually. 14.98 is more correct. Point 55. So it is multiplied by 10%, 5.52, and then 10 we need to add to 15.52 with the answer. 15.52. Okay, there may be a certain error, but you need to calculate like this. Okay, the formula is basically rate at NPV1 plus NPV1, then NPV1 minus NPV2 multiplied by rate NPV2 minus rate NPV1. This is basically the formula, and then you will get the percentage where, okay, we can test here as well. So if I calculate at 14.98, what would be the issue? 1.4. So it is 43. In somewhere because of point error, but 14.998 instead of it is 14.99, it is like this. And here if you get like next, okay, so it is more or less there is a certain point error, and because of that reason we are not able to get the right answer. It is in between 14.98, maybe the 14.99, like this. Okay, so if your hurdle rate, say for if I assume it is 14.98, okay, and if your hurdle rate is 15%, okay, then you can accept the project. Sorry, then you can reject, okay, because you need a higher return, okay, but you are getting a less IRR. But if your expected rate of return is 10%, then you can accept the project. So always you can accept the project when the hurdle rate is less than IRR. If the IRR is higher than a hurdle rate, then you need to accept the project. Okay, so here the IRR method determined the present value factor that yield NPV equal to 0. So that is basically IRR. And then again, except when hurdle rate is less than IRR. Okay, so then and only then you should accept. If it is more than IRR, then you need to reject it. Unreasonable reinvestment assumption. So cash flow generated by the investment are assumed in the IRR analysis to be reinvested. Okay, so that is basically the assumption. Whenever we are calculate the NPV for any purpose, okay, it is assumed whatever may be the profit generated, that is reinvested in the business. Okay, then inflexible cash flow assumption means the timing of the amount of cash flow used to determine IRR can be misleading when compared with the NPV method. The IRR method is less reliable than NPV method when there are several alternating period of each net cash flow. See what happened if the cash flow is like plus, say for first cash flow is minus 1 lakh. Okay, then second cash flow is 20,000. Third cash flow may be again minus 1 lakh. So in that situation, NPV is more reliable. Here what happened, there is again reinvestment. So you cannot calculate the proper IRR. Okay, so that is basically the limitation. And the IRR method evaluate investment alternative based on the achieved IRR and does not consider the dollar impact. Okay, because see, if you are evaluating like the project A, okay, they give an IRR of 18%. Okay, project B, they give a IRR of 12%. Okay, but in project A, NPV is basically the 1 lakh net present value, and the project B NPV is 5 lakh. Okay, even though as per IRR this one is better, okay, but if I'm getting an additional earning in a dollar amount, I should go with the project B. So IRR we generally opt when we have an similar NPV, similar investment required, okay, but if the different IRR, then we need to go go with the higher IRR project. Okay, first we need to evaluate the project at NPV level. Okay, if there is if you see here 1 lakh 5 lakh, okay, so if I'm getting a same NPV, okay, so in that situation I should different NPV, then I can easily select, but I'm getting an 1 lakh 1 lakh. Okay, so in that situation I need to go with the higher IRR. I mean, this will be my selection. This the project A will be the selection. Okay, any doubt here? Anyone has any question? Okay, then I'll ask the question. Like project A NPV is 1 lakh, project B NPV is 1 lakh. Okay, but the IRR different. There is a difference. Why this may happen?
The rate at which NPV becomes zero is IRR.
Yeah, but if I'm discounting and I'm getting a same NPV value, any guess?
The cost of capital would be less.
Okay, higher capital, lower capital, but I'm getting the same profit, na?
No, sir, the rate at which our inflows and outflows would be zero. So in project B, it would be much less,
Yeah,
but in project B, it is more.
project B at 12% it is a zero, but I'm getting an same NPV. That I can understand. Okay, at 12%, like project is zero, but if I'm calculating the 1 lakh, then it is and in the project A also the same NPV, but I'm getting an IRR 18%. So what happened? Means my NPV discounting rate is here for project A plus 18%, and for project B it is plus 12%. That's for sure. If I'm getting a positive value. My question is, even though I discount at a 12% or I discount at an 18%, still I'm getting the same IRR, same NPV. So someone said the capital, I mean the capital fund may be different. Investment may be different. Anyone want to consider this factor?
Sir, I meant the cost of capital.
Cost of capital, yeah, okay. Cost of capital is definitely different. That's why it is an 18% and 12%. But that is not the reason of same IR. See what happened, project A may recover the investment in a 3 years. Okay, and the project B may recover the investment in a 5 years. That is the reason. Okay, so because if the time period is span is high to recover the investment, then your IRR automatically get reduced. Okay, and capital is not the case, because if you invest more amount, you will get the more return. Okay, so it is not because of this. Generally, this kind of situation arises when there is a different time frame. Okay, if I am able to recover my investment at a higher rate, that means my IRR is high. Okay, so I mean, are you able to understand how to calculate the IRR? Again, IRR, sorry, return at NPV1, okay, plus NPV1 divided by NPV1 plus, sorry, minus NPV2 multiplied by R NPV2 minus R NPV1. That formula you need to memorize. Okay, here that formula is not given. Okay, so if an investment of 50 on 100, then there is a 200% return. If an investment of 50,000 on 25,000, then there is a 50% return. Okay, but the IRR method would suggest that it would be best to invest 50 to 1 on 100 and receive 200% return, while the NPV method would favor the larger NPV, 25,000 on the 50,000 investment. So if you don't have any scarcity of the investment, it is better to go with the NPV. Means always, even in practical scenario as well, first you need to evaluate the NPV. If you are getting a higher NPV, then you need, and you can accommodate the investment, then you should go with the higher NPV. Okay, if you are not able to accommodate the investment, then maybe you can bifurcate profitability index that we discussed in a last class, and otherwise you can evaluate the IRR, and accordingly you need to prioritize your investment opportunity. Then payback period. So payback period is basically you have, we'll take the same example. Okay, but here, okay, you need to consider 10%. Okay, so in payback period, this is basically the normal cash flow. And this is discounted cash flow. Okay, and the same way there are two type of payback period, normal and this is discounted. Okay, so what happened if you see here to recover the 2 lakh, okay, so like this 1,40,000 and here it is more than 2 lakh, means in a 4th year you are recovering. So it is basically 3 year plus in a 4th year how much you need to recover? 60,000, but you earn 70,000. Okay, so 60,000, which is remaining recovery, divide by in a 4th year you recovered the 70,000. Okay, so this is my normal. So it is 3 and plus 60,000 divided by 70,000. So which is 85. So 3.85 is my payback period, normal. Okay, I mean, method is for the normal and discounted, the method is same. Only thing is that if you are using the normal cash flow, means before discounting, then it is a normal payback period. And if you use the like discounted cash flow, then it is discounted payback period. Okay, again. So here it is again negative 40,844 in a 5th year. Okay, we are positive. So it is 5th plus. Okay, how much we are negative? At the end of the 4th year, 4844.20. 4844.20. Okay, this is basically the comma. And divide by in 5th year, 74,510.56. Okay, and now we need to calculate. So here 5th, here 4844.20, 74,510.56. So it is 5.54. Why we calculate this period? Means 3.85 year, 5.55 year. At 3.85 year or 5.54 year, I recovered my entire capital. That is my assumption. Okay, so whatever may be the profit, if I take it from the business, okay, so that means I recovered my entire amount. Okay, so that is basically the, whenever you are doing any capital expansion or the capital investment, okay, you need to first calculate what would be my payback period, and means by what time I can recover my investment. Okay, so yeah. So if you see net initial investment divided by average incremental cash flow. So where cash flow is even. So when it is an even, then you can calculate easily. But if it is uneven, then the way I want to means I just calculated. Okay, so if it is even, so it is like 2 lakh, and if it is 20,000 is even, no, it takes then 20,000. So it is 10 year required. Okay, so you can recover the your investment in 10 year. Okay, but if it is uneven, then you need to calculate like this. Means by when, in which year your net cash flow is a positive, and then you need to calculate the proportionate of that year. Okay, so uniform cash inflow. So payback period is computed. It is not necessary that payback period you can compute it for the uniform cash flow. If it is an non-uniform, even then this way you can calculate. So project evaluation, in case of a project, net annual cash inflow would be net cash receipt associated with the project. Asset evaluation, in case of the purchase of equipment, the net annual cash inflow will be the saving generated by use of the new equipment. Okay, so like what is the difference in project evaluation and asset evaluation? Can anyone tell? It is the fixed asset, maybe single, okay, which gives you the cash flow in terms of saving. Okay, why it is in terms of saving? See, if I use the asset, then maybe some of the operation which I'm doing right now manually, maybe it is I'm doing means automatically. Okay, and this may give us the higher production. Okay, so there may be a saving. Okay, so there is no additional cash flow. Okay, so it is basically the sale and everything, but there may be a certain saving. This will consider as a cash flow. And in a project, of course, you install the project and then you started to sell the material, and then you are start to get the income. Okay, so that is basically income, means actual income is actual cash flow. Okay, so that is basically the difference. Depreciation tax shield. So we generally means whenever we calculate the payback period, it is on cash basis. Cash basis, not on profit basis. Okay, so we just consider the depreciation tax shield, means tax shield on the depreciation. Okay, because we are able to save the taxes. Okay, but at actual depreciation we are ignoring. Okay, so we need to consider this example. Helena company is planning to acquire 2,50,000 machine that will provide increased efficiency. So whether it is a project evaluation or the asset evaluation, can anyone tell? Any guess? As we are talking about the efficiency, then it is asset evaluation. Assuming 40% of income tax rate, okay, and the 80,000 is operating cost, the machine will be depreciated by the straight line method over a 5 year if no salvage value at the end of the 5 year. Assuming 40% tax rate, calculate the machine's payback period. Okay, so like the regular operating, means it is saving of operating cost, that we need to consider is income. So it is 80,000. Okay, and the machine get depreciated by 5 years, means 50,000 per year. Okay, so it is basically you need to consider the 12,000 it is a tax shield. if I'm getting an additional tax benefit actually. So saving in operation, just one minute, also referred to as average expected. Okay, so yeah, so it is 80,000. Okay, so you need to pay the it is not like this 80,000, and you need to pay the tax on this 80,000. Okay, so it is 32,000, but there is a tax shield on the depreciation. Okay, which is basically 50,000 is my depreciation multiplied by 0.4, so it is 20,000. Okay, so this is my liability minus additional liability, because saving in expenses, so I need to pay the higher taxes. Okay, okay, and this is additional expenses, so overall 12,000 is my additional liability. So whatever maybe the saving is 80,000, okay, that I need to reduce by 12,000 because I need to pay the higher taxes. Okay, so 68,000 is my net cash flow because of use of the asset. Okay, 12,000 is net impact on a tax. How we calculated it? 80,000 on which we need to pay the tax, but 50,000 where I can save the this is my savings, this is my depreciation, means I can claim. So the taxable income is 30,000, and on this I need to pay the 4% tax. So additional tax I need to pay 12,000. So because of saving of 80,000, I need to pay the additional tax of 12,000. So my net cash flow is 68,000. Okay. Now the investment is 2,58,000. So payback period is 2,50,000 divided by 68,000. Let's see. I hope so. Yeah. So it is 3.68. Okay. Just keep in mind again, like there is a saving, okay, 80,000. So it is not my total saving because I need to pay tax on it, which is 32,000. So my net saving is 80,000 minus 32,000. So it is 48,000. Okay, and then there is a depreciation which is 50,000. On that I am able to get the tax benefit of 20,000. Okay, so that will be my additional earning. So my total net cash flow is 68,000. Clear? Then non-uniform cash flow, which I already explained to you. Okay, so we can directly take an example. It is the investment is 2 lakh, then minus 90,000. Sorry, it is plus, it is minus, plus 80,000 plus 75,000 and the plus 60,000. So these are my total cash flow. Okay, yearly cash flow. Okay, so here if you see 9 plus 8 1.7, still there is a minus 30,000. Okay, it is 1,70,000. Okay, if I consider this, so it is minus 30,000. So I am not able to recover by the end of 2 years. But in third year, it is a 75,000. Okay, so if I consider this, then it will become the plus 45,000. So my payback period is somewhere in between. So it is second year and this is third year. Okay, so how we are going to calculate? 30,000 is my remaining collection. Okay, 2 year is plus, then 30,000 divided by 75,000. Okay, so 2 plus whatever may be 30,000 divided by 75,000. If you can see here, 2 and the 30,000, it is 40%. Okay, 40% or 0.4. Okay, so 2.4 is my payback period. Whatever may be the remaining recovery, means in the year we are going to become a positive. So by the end of previous year, whatever may be the remaining recovery, this I need to keep in the numerator, and then whatever may be the cash flow of that year, that I need to keep in a denominator, and this will give me the 2.4 payback period. Okay, and discounted payback period is, if you use the discounted cash flow, then it is discounted payback period. Then the advantages and limitations. So it is easy to use and understand. We can easily calculate. Okay, and emphasis on a liquidity. We are not considering the profitability. We are only considering the liquidity. Okay, but in a normal cash flow, okay, normal payback, okay, but in discounted payback, because we discount the cash flow with a hurdle rate or the expected rate of return, so here we are considering the profitability as well. So limitation of the payback, the time value of money is ignored. Okay, why we are saying the time value of the money ignored? Because if I get the 2.4 years, okay, after that also we are getting some profit, that we are going to ignore. Okay, so that's why the time value of money get ignored. Projected cash flow occurring after the initial investment is recovered are not considered. Means if your recovered are not considered, means like if you have in next year, if you have some positive cash flow, okay, so it is assumed we are going to recover it, or we are going to take it from the business. Okay, then the reinvestment, because we are going to take it from the business, that's why reinvestment of the cash flow is not considered, and the total project profitability is neglected. We are not calculating what profit we are able to get it. We just calculate by for what time, by what time we can recover our investment. So these are basically the limitation of the payback period. In a discounted payback period, it is more or less same. Again, focus on liquidity and profit. So here, because we discount with the hurdle rate or expected rate of return. Rate. Okay, so that means we are considering the cash flow as well as profitability. That is the advantage of the discounted cash flow over the normal cash flow. Okay, evaluation term, the computation begins with the project term is formed and end when the initial investment has been recovered, and using the discounted payback. Okay, so discount payback or BT is often used to evaluate new product development project of the company that experience rapid technological changes. Okay, so these are basically the objective and the advantages and limitation. The advantage of the are the same as the payback period. More or less it is same. The only positive point is we are considering the profitability in a discounted cash, discounted payback period. Any doubt here? Okay. Anyone has any doubt in IRR concept? Okay. Now economic value added. Okay. So whenever we see the balance sheet, we know net income. Okay. So why we are saying it is not same? Okay. Mainly because there may be a certain opportunity cost. Opportunity cost is basically whoever invested the amount, okay, they expect some return, or investor expect return. Okay, that you need to deduct first. Then whatever may be the amount available, that is basically the economic value added, EVA. Okay, required return, where required return investment multiplied by WACE. So this investment, okay, who are going to do this investment are shareholder. This investment, okay, weighted average cost of capital is basically when we calculated like cost of equity, cost of debt, cost of equity, cost of debt, and in proportion they invested like 70% or 30% like this, and then we calculate weighted average cost of capital. So whatever may be the investment we made, okay, it is net profit, net operating profit after taxes, I mean before interest, okay, but after taxes, and then we need to reduce whatever may be the weighted average cost of capital, okay. So that will become my EVA, okay. So economic value added is basically the net operating profit minus return on investment, I can say, investment, okay, that is my EVA. So if it is positive EVA, indicate that there is a positive economic profit and strong performance. Negative EVA, that means you are not able to recover your return on investment. Even though there is a positive profit, but if the EVA is negative, that means you are not able to recover expected rate of return. ROI, okay. So investment valuation issues, okay. The organization may capitalize the research and development cost as a part of the asset base along with other value added investment in advertising and training, and the current valuation of the balance sheet. Balance sheet accounts are generally revalued to the represent current cost, okay. So we cannot, I mean, see what happened. Sometimes the research and development expenses we capitalize it, okay, and this will added my asset base, okay. So if this get obsolete, that then we need to consider this as a like the fictitious asset, okay. So that is basically the issue, and in a balance sheet we generally we need to revalue the asset, but we generally represent in a historical cost. So these are basically the issues while doing an investment valuation. Then income determination. Net operating profit after tax may be adjusted to eliminate the effect of certain transaction and thereby create nearly cash basis income statement. So adjustment to the balance sheet affect the income statement, and the deferred taxes are ignored. So these are basically the like while doing an income, okay. So adjustment to the balance sheet affect the income statement means sometime what happened, we make a provision for doubtful debt. This is not the actual expenses or the warranty obligation. These are not the actual expenses, but just to show the correct financial situation, we are making certain provisions, okay. So that basically affect the income statement, and deferred taxes also get ignored. Deferred tax is also just like a provision. So we can see the EVA. The InstaFab Manufacturing has an investment in its Southeast regional plant with an investment of 300,000. The company's cost of capital is 12%, and the division produces a net operating profit after tax 50,000 after adjusting for current year research and development, asset revaluation, and other accounting consideration. Okay, so that is basically the 50,000. So 50,000 is my in net income. After that means the 12% on 3 lakh that we need to adjust, which is somewhere 36,000. We need to reduce. This is basically the expected return on investment. Okay, so whatever may be the remaining, it is how much? 14,000. Okay, that is my economic value added. So it is simple, means economic value added is basically whatever may be the net operating income that we need to adjust it for any revaluation or the any research and development. Okay, asset revaluation or other accounting consideration means if we do the asset revaluation and increase the value of the asset, then there is a, the second effect goes to the credit to P&L. This will increase the profit that we need to reduce. Okay. And if there is a certain research and development which we capitalize, okay, that also we need to reduce. So we come to know what is my exact net profit, operating profit, okay, and after that I need to deduct whatever may be the return on investment expected my shareholders, okay. So like 36,000 means the 12% return on 3 lakh investment, which is 36,000. So whatever may be the balancing, that is my additional profit, which is EVA. 14,000, not 1 lakh 40,000. Yeah, 14,000. Any issue here? Then probability and the expected value. Okay. Probability means, see, if I want to decide my sales, 10,000 probability is 20%. Okay. 50,000 probability is 40%. Okay. No, not, this is not for the sales. Okay, 60 and the 40% for 70,000. Okay, so how we are calculating? 2,000. These are my expected value for 20,000. 28,000. Generally, this way sales we are not going to, but if any expenses or any any variable we are going to calculate, okay. So like to get the income of 10,000, my probability is 20%, 50,000, okay, and then accordingly means it should be the 100, and accordingly we will calculate 22 plus 28, which is 50,000. Yeah, 50,000. Okay, that is my sales or the profit. This way I am calculating. So probability is basically what is the chance to get. Okay, to get the 10%, it is 20% probability. To get the 50,000, it is 40% probability. To get the 70,000, it is a 40% probability. So 50,000 would be my sell. Expected value is the weighted average of the weighted average of the probability assigned to each expected outcome occurrence. For example, the probability of selling 5,000 car is 20%. Probability of selling 4,000 car is 80%. So expected value is this way. So this I am going to consider as a sales. So whenever I am preparing a forecast, okay, so I check with my sales team, okay, if I consider the sales value, okay, what is the chances of getting that sales value? So generally the ratio should be in other way around, means to get the 10,000, the ratio, it should be the 70%, 50,000 it should be the 20%, and the 70,000 it should be the 10%, like this in a practical scenario. Lesser the sales value, the chances is very high. But then in a forecast, I will consider the 50,000 as my total sales. Okay, marginal analysis. Any doubt here? Why we do the marginal analysis first? Okay, so here my revenue, this is my cost. If I am producing first product, I am able to get the 10,000 and my cost is 7,000. Okay. If I produce two product, I may get the profit of sale of 18,000, but my cost is 14,000. Three pop product, 24,000, 21,000. The fourth one, if I sell the fourth product, 28,000, 8,000. And when I am producing 5 products, 35,000, and here 30,000. Okay. So here if you see, the profit is 3,000. Okay. For additional revenue of 8,000, I need to incur the cost of 7,000. Okay. For additional revenue of 6,000, I am incurring the cost of again 7,000. Okay, additional cost. Okay. If you see the combined profit, here the profit is 3,000. Here 18,000 and 14,000. Okay, the profit is 4,000. But here my profit goes down. So this is my optimum level. Even though you are seeing like 24, 21, we are getting a profit, but at a higher level, I am getting a 4,000 profit. But if I produce additional third item, then I am getting a 3,000. Means my profitability get down. Are you able to clear this issue? First 10,000 revenue, cost 7,000. Okay. So my profit is 3,000. For second case, 18,000, but the cost is 14,000. Okay. Here for additional 8,000, I need to incur the 7,000 cost. Still I am getting a 1,000 additional profit. So it is 4,000. Okay. But in third case, when I am getting 24,000 revenue, but cost is 21,000. Okay, so my profit is additional. First we calculate 18 to 24, it is 6,000. Against that I need to incur the 7,000 additional cost. Okay, this will give me the minus 1,000. Okay, if it is 4,000, 1,000. Okay, so it is the net profit is 3,000. Okay, so when I produce third item, okay, my profitability goes down. So it is better I should produce only up to second item. That is basically the marginal cost analysis. So whatever may be the additional revenue, you need to compare with additional cost. Okay, if additional revenue is greater than, like plus then additional cost, okay, then it is okay. But if it is less than the additional cost, then you should reject. That is basically the marginal cost analysis. Okay. Now, okay, like say for like when you are producing one product, raw material, variable cost, fixed cost. Okay, so raw material is 10, variable cost is 5, and the fixed cost is 2. Okay, when you are producing second product, okay, it is 10, it is 5. What is my sorry, it is 20, it is 10. Okay, what is my fixed cost here? Can anyone guess? 4, right? Yeah, am I audible? I hope I am audible. Any guess? Can you confirm this is correct or wrong? It is a fixed cost. It should be 2, not 4, because fixed cost is static. Okay, so total cost is here 17 and here 32. So what is my additional cost here? 15. Okay. So if I not consider this and I consider only this cost, so again it is 15 and 30. So again additional cost is 15. So always you can ignore the fixed cost. Only additional relevant cost you need to consider. So generally it is a variable cost. Okay. So it is given direct cost, primary cost and discretionary cost arising from the periodic budgeting decision by management to spend in areas not directly related to the manufacturing. Means it is only those costs we need to consider which is additional or relevant for the product. If it is a fixed cost, then it is not the part of decision making, because anyhow you need to incur it. Okay, even if the volume is 0, even if the volume is 5, the same cost you need to incur. So that is not basically the part of evaluation. So cost to maintain landscaping at a corporation are generally viewed as a discretionary. Okay, so they gave a discretionary cost. Incremental cost, as we already discussed, also known as marginal cost, the differential cost out of the pocket cost, the additional cost incurred to produce additional amount of the unit over the present output. So incremental cost are relevant cost and include all variable cost and any avoidable fixed cost associated with the decision. Okay, so like what happened here, the fixed cost I gave 2. Okay, so instead of that, okay, or I'll take another example, leave it, first we just discuss this. Then opportunity cost, the cost of foregoing the next best alternative. Okay, so opportunity cost is basically, if I produce 10 quantity of product X, okay, I may need to use 3 hours. Okay, and if I produce a 5 quantity of product Y, that also I need 3 hours. Okay, and I have only 3 hours, then I need to decide whether I should produce product X or product Y. Are you okay with me? Okay, so how I'm going to select which product I need to produce? Any guess? Just a rough estimation. Okay, so product X give me the contribution margin of 20 and product Y is giving a contribution margin of 50. Now you can tell. Any guess? In 3 hours I can earn 20 and in 3 hours I can earn 50. So means what what should be my willingness, whether to earn the 20 or whether to earn the 50?
150.
50, yeah. So I'm going to produce product Y. Okay, so whenever I'm going to do any costing decision, say for example for product X, product Y, contribution margin means if here 100, okay, so my cost is here 80, this will give me the 20, and here 100 and my cost is 50, this will give me the 50. Okay, so what happened, whenever I'm going to evaluate, how I'm going to evaluate? 100, 80 and plus if I use the product X, so that is also the cost, because I am foregoing this profit. Okay, so technically my cost of producing product X is 230. Okay, the same way product Y 150, but here I am also foregoing this 20 as a profit, so that also I need to add. Okay, so again here 170. Okay, sorry, it is not like this. 100, this is 130, so it is minus 30, and here it is 70, so it is plus 30. Sorry, it is not the total, this is the sales, this is variable cost, and this is opportunity cost. Why opportunity cost? If I'm producing the product X, okay, so I'm foregoing the profit of product Y. So that's why I need to consider as an additional cost. So 100 minus 80 minus 50, this will give me the negative 30 number, and here 100 minus 50 minus 20, this will give me the positive. So again we need to use the product tax. Okay, so that is basically the opportunity cost. Means whatever may be the profitability you are going to foregoing because of selecting other alternative, that can be a part of that cost that you need to keep in mind. So cost related to the special device that is necessary if special order is selected are relevant, and the cost associated with the alternative use of the plant space are relevant. So I'll just giving a example in a number. Okay, so say for you have an 100 hours. Okay, again the product tax. Okay, if you are manufacturing product X for, and you may take 100 hours, you can earn 50. For manufacturing product Y, okay, so what happened, whatever may be the raw material you required product X, that also again this is contribution margin. Okay, that is also you need to use in a product Y, plus you need to additional 10 you need to incur. Okay, so say for here the 100 is my cost, so 100 plus 10, so it is basically the additional cost of 110. Okay, then because I am not manufacturing the product X, so that's why whatever may be the contribution, that also I need to add in my cost as an opportunity cost. Okay, so here total cost is 160. So I can sell my product Y at a price which is greater than 160. Okay, keep in mind product X. Okay, it start, I mean the calculation is sales 150, cost 100. Okay, so this will give me the profit of 50. Okay, now I want to decide this what could be the price for product Y. How I am going to calculate? Here 10 rupees I need to pay additional, so this is 110 plus 50 which I am going to foregoing, so that should be the 50 I need to keep it. Okay, so 110 plus 50, it should be the 160. So if I'm generating more than 160, say for 170, okay, now you can calculate. Okay, so it is sorry, that you need to ignore at this moment. How much? It is 60, which is greater than 50. Okay, then and only then makes sense. Okay, if you are selling it at say for 100 and 110, 100 more than 110, say for 130. Okay, so it is 20 profit, which is less than 50. So why you are selling product Y? So you need, it is better to sell the product X. So whatever may be the profit you are going to forgone by shifting to other product, that also you need to consider. And for shifting other product, whatever may be the additional cost you need to incur, that also you need to consider. So here 10 plus 50, that is basically the additional cost, which is 60. Your original manufacturing cost is 100. So it is, you need to sell your product more than, greater than 160. Okay, this is basically the minimum price. Or not even minimum, it should be the plus. Okay, if you are selling at 160, okay, so again the cost is 110, so you are using getting a same profit, then why you are shifting to other product? Okay, are you able to understand? Any doubt here? Okay, then irrelevant costs that do not differ among alternatives are irrelevant and should be ignored in the marginal cost analysis. Okay, so generally it is the fixed cost. Means if you are shifting from product X to product Y. Okay, so in product X, my basic cost is 100 plus sell price is sell 150 and the cost is 100. Okay, and the profit is 50. Okay, what happened in product Y? Okay, it is basically the 200, the cost is 110, so this will give me the profit of 90. Okay, so here what happened, this 100 is basically the common. Okay, so if I compare this additional 10 plus additional 50 and the additional revenue 50, okay, so that is also the sufficient. Okay, see what happened, like this 100 is common, this 150 is common, so additional revenue is 50 minus 10. Okay, so this will give me the profit of 40. Okay, which is basically the additional profit. Okay, so whatever may be the relevant cost, or whatever may be the cost which applies to both the alternate, that you can ignore, you can just consider this 10. So irrelevant cost is basically that do not differ among alternate, means here also you need to incur the 100, here also you need to incur the 100. So these are basically the irrelevant cost. Sunk cost, this is again unavoidable because they were incurred in the past and cannot be recovered as a result of decision, that also you can ignore. Okay, so as I said, fixed cost is always constant, you cannot reduce your fixed cost. So that's why in any analysis you can ignore it. Okay, so you can see the example. Electromag Corporation is evaluating whether to replace the piece of equipment. The cost of the old equipment is sunk cost and is not relevant to the replacement decision. So additionally, under either alternative, the anticipated cost of electricity remains the same. The cost of electricity is variable cost. Even so, the cost of electricity is not relevant because it does not change regardless the selective alternative. So here I am using a machine A and machine B. Okay, machine A cost me 1 lakh and machine B cost me 2 lakh. Okay, if I replace the machine A with machine B, this will give me the additional saving of 4 lakh saving. Okay, so how I am going to calculate whether it is okay or not? It is savings 4 lakh. To generate this saving, what I am doing? I am buying a machine B, okay, which is 2 lakh. Okay, any adjustment we need to do for this 1 lakh? Any guess? Because this is also the the cost. Okay, so even though I shifted to this, I need to bear this cost, so that is not part of the evaluation. Okay, because it is not affect the total asset of the company. Okay, but what happened if I am able to sell this machine at a 10,000? Okay, so in that situation I can again add this as a 10,000. Okay, and then I can evaluate what would be my net savings. So it is 4 lakh 10,000 minus 2 lakh, which is basically 2 lakh 10,000. Okay, so if it will not affect in both alternate, then you can ignore that cost. But if you are able to generate some saving or some realization value, then maybe you can factor it. Okay, see, this is basically your outflow, saving is your inflow. Okay, sorry, this is basically the inflow and the cost is basically your outflow, and plus by selling a old machine, this is again your inflow. Okay, so if you are able to recover, okay, the original cost is not matter to us, but whatever the cost we can recover today, that we can adjust it. Controllable costs that are authorized by the business unit manager or the decision maker. The ability to control cost is evaluated when analyzing the business decision. Okay, so like company A and they have a division. And division C. Okay, what happened? And this is basically the head office. Okay, so division A is incurring and marketing expenses of 30,000, which he can control. 20,000, which he can control. These are all marketing expenses. Okay, and the 10,000, which he can control. Okay, that we need to consider for project analysis, because it is in their hand. They can reduce or they can increase. Okay, so that's why we need to consider. Okay, but head office charging 60,000 to each department or each division, the same amount, okay, which they cannot control. They need to absorb, because it is a management decision. So in that situation, you cannot use that. Okay, so that is basically the uncontrollable. Okay, if it is uncontrollable, so then it is not the part of any analysis. Okay, and if it is controllable, like this one, this one, this one, you can increase or decrease, then you need to evaluate whether they are going to increase or decrease. So part of analysis. Okay, so like cost were authorized at different level in the uncontrolled are not relevant costs. It is not the part of analysis, because you cannot control it. If I want to measure the performance of the division head of a particular division, okay, so whatever the action he can take, only those costs I am going to consider. Clear? Okay, so controllable versus uncontrollable cost. Anyone can give the example of the controllable cost and uncontrollable cost? Here they gave the depreciation, but generally the management fees which come from the corporate, or the IT costs which come from the corporate, these are basically the uncontrollable cost. But hiring a people or the contract people, these are basically the controllable cost. Avoidable cost and revenue. Cost and revenue that result from choosing one course of action instead of another. As a result, the firm avoid the cost and revenue associated with the course of action not selected. So they are relevant to the decision. Okay. So any cost or revenue which you can control, or you can avoid, or you can additionally generate, that is the part of analysis. Unavoidable cost means the fixed cost which you cannot control or you cannot avoid. Okay, that is unavoidable cost, and unavoidable cost are not part of any analysis. Okay, so like, because again the special audit decision is a topic which we need to take. Okay, so we will take a 15-minute break here. So it is, we will join then 8:40. Okay. Okay. So special order decision. We should consider two issues. Okay. So if you operate at a full capacity and if you operate at a under capacity, okay. Yeah, we need to consider variable cost and the fixed cost. Okay, so variable cost is 100 and the fixed cost is 20. Okay, if you operate at a full capacity, and the like profit also you need to mention. Instead of profit, I'm using the contribution margin, which may be the 50. Contribution margin is basically like sell minus variable cost. Variable cost. Okay, if you're operated at a full capacity, okay, and the same here, variable cost is 100, fixed cost is 20, and the contribution margin is 50. Okay, so if you operate at a full capacity, okay, so in that situation you need to make sure, means if I consider this one, so my sales price 80, 100 plus 20, 120, and the sell price is say for 50. So 150 would be my sell price. Okay, because my contribution margin is 50 and variable cost is 100, so 150 is my sell price. Okay, same here is 150. Okay, now if someone come to me and he said, okay, can you produce it same product for me, and what price you are going to charge me? This is basically the question. Okay, so here I am getting the sales revenue of 150. Here also I am getting the sales revenue of 150. Okay, now what happened if I am operated at a full capacity, means I am able to get utilize my entire capacity, and I am already getting a maximum profit. So in that situation, if I want to charge someone, okay, so how much I need to charge, which is more than 150. Okay, because at 150 I'm earning some profit, say for 30. Okay, so if someone is saying, okay, you can, even though you are operated at 100% capacity, can you produce some quantity for me? So in that situation you need to charge more than 150. Why? So that you will get the profit more than 50, contribution margin more than 50. Okay, so how I am going to calculate this 150? What is my variable cost? 100. What is my opportunity cost or the contribution margin? Okay, 50. So my sell price should be more than 150. Clear? This is my opportunity cost and this is my variable cost. Okay, as I am operated at a full capacity. Okay, why I need to consider this separately? Because I don't have a capacity, so I'm losing this profit, means I'm sacrificing one production of this quantity, okay, for certain customer, okay, and I'm losing that opportunity and I'm producing for certain other customer. So if I want to do this, then I should get the price which is more than 150. sell price. Okay, but if I'm operated at 100%, not full capacity, under capacity, okay, so in that situation I just need to compare the variable cost 100. If I'm getting additional 120 selling price, this 20 is additional contribution margin. Why? Because I do not require to sacrifice any pending order that I can execute. I have a surplus capacity. My fixed cost is as it is, so it is irrelevant, but I need to incur additional variable cost. So that's why I need to consider this, and I can charge 120 as well. Okay, so if I operate at a full capacity, then I need to add back opportunity cost. But if I operate at a under capacity, then I need to consider only variable cost. So whatever may be the sales value I am getting more than variable cost, this is an additional contribution margin for me, because I do not require to sacrifice any sales if I operated under capacity. But if I operated at a full capacity and I'm getting an additional opportunity, okay, then I need to sacrifice something. So I need to add back that sacrifice in variable cost. Clear? So we can see here the example. A Kator company is a manufacturer of an industrial component. Our product KB96 is normally sold at 150 per unit and has the following cost. Okay. Has received a special one-time order for 1000 unit. Okay. So first they have not given required. Assume that the Kator has an excess capacity. Calculate the minimum acceptable price for the. Okay, so that means he has an excess capacity. That means he is underutilized. So in that situation, we need to consider only variable cost. Okay, so like direct material 20, direct labor 15. These are variable. Variable manufacturing overhead 12. Fixed manufacturing overhead that you do not require to consider, and the shipping and handling cost 3. I am assuming this is all fixed. Variable, sorry. Handling cost. Okay. So these are my all variable cost. I am assume it is underutilized. So I do not require to add opportunity cost. Okay. So what is 35 and the 15? 40, 50. My sell price should be more than 50. Let's see. Okay. So the fixed manufacturing overhead and the fixed selling cost are not relevant to the decision. The incremental per unit production cost is the total variable cost per unit of $50. So Kato should accept the special order only if the selling price per unit is greater than 50. Why I'm okay with this? Because it is an underutilized. I do not require to sacrifice any existing order, and because of that reason, I'm just evaluating whether I'm able to cover all my variable cost or additional cost with no excess capacity. Okay, I think assume the same cost. So same we are going to consider. Has received a special one-time order of 1000 unit. Okay, assume that the operating at a full capacity. Okay, and assume that the next best alternative use of the capacity is the production of LB64, which would produce a contribution margin of 10,000. Okay, so 10,000 should be the contribution margin. Okay, so like 50, as we know the variable cost. Okay, 10,000 contribution margin we are going to sacrifice. Okay, so like for 1000, or what I need to do, 10,000 divide by 1000. So per unit is 10. So that I need to add here, and my selling price should be more than 60. Yeah. So Kato's next best alternative use of its capacity would produce a contribution margin of 10,000. So that I'm going to sacrifice. Okay. So 10 is basically 10,000 divided by 1000, and this 10,000 is my opportunity cost. Okay. because if I accept the special order, then I cannot generate that contribution margin. So that also I need to add here. Okay, and because of that reason, the 60 would be means the sell price should be greater than 60. Okay, so this is basically when you are evaluating special order, and there are two scenarios. One is basically the special situation, or how I can say, underutilized, and one is basically the utilized capacity or full utilization. Okay. So the acceptance of a special order also requires the consideration of a number of strategic factors. Okay. So because you cannot you cannot focus on the profit. Okay. You may just you are breaking your existing customer. That is also not the good. So these are some qualitative factor. So the effect of regular price sale and other long-term pricing issues, that also you need to consider. The possibility of future sales to this customer, means whether we are able to generate additional business from him. Okay, see what happened if I charge higher price, okay, to particular customer, and at that time he is accepted because of some urgency, then he is not going to come back to you. Okay, because he feel that you are charging a higher price. So that also you need to understand. You need to understand what is the potential with this customer. The possibility of exceeding plant capacity or the complexity of the order itself. Okay, so if you are, I mean, just like the chances to build the product. Okay, if particularly when there is a customized product, to chances to build this product may require a special effort. So that also you need to consider. You cannot go only by the profitability. Okay, if the chances of failure it is more, then it is better to satisfy with the lower profit. The pricing of the special order, of course, means okay, one more issue. If you quote a lesser prices for particular special order, that can become a reference for the your existing customer. So that also you need to keep in mind. The impact of income tax, of course, that also you need to consider, and the effect on machinery and or schedule machine maintenance program. Because see, some product when you are manufacturing, okay, sorry, when you are manufacturing, it requires a special tools. Okay, so that could be the additional cost, and it requires the special functioning of the machine. So that also you need to consider. Means if you machine a steel plate, okay, so that machine you can use for a longer time. But if your same machine used for a graphite plate, then you can use that machine for a 2 or 3 years time. So that also you need to consider. Then make versus buy decision. In the same way, excess capacity and the no excess capacity. Again, variable cost, fixed cost 100. If you have an excess capacity, okay, in that situation, if someone is quoting less than 100 or for 90, then you can buy. Okay, because this is anyhow your loss. Okay, so that may not be the relevant. Okay, so you should buy at a 90. Okay, because if you buy say for at 120, okay, even though your cost is 150, this 120, but because of underutilization, this 50 also you need to add here, and then your cost will become the 170. Okay, so like this. So it is again you're not able to afford, means your current cost is 150, now the existing cost is 170. So makes no sense. Okay, even though it is less than 150, Okay, but still, because this cost you need to incur, so that is an additional cost for you. So it is, I mean, that product is basically for you it is 170. Okay, so that's why whenever there is an excess capacity, make sure the alternate option or buy option is for less than variable cost. Okay, but if there is no excess capacity, so in that situation you can compare with entire 150, because then you need to go for a capacity expansion, and this will additional fixed cost generated. So that also you need to consider. Okay, if the product is not made plus the opportunity cost associated with this decision, so you need to compare this 150. Okay. So avoided or saved means variable cost. So the product is not made. So this will be the maximum outside price. The cost of making internally is the cost that will be avoided, saved if the product is not made, plus the opportunity cost means this fixed cost. This fixed cost means this could be the additional cost if you expand the capacity. Okay, not the existing. Okay, keep in mind, because if you exhausted your capacity means okay, your plant is completed now. Okay, but if you want to still manufacture that product and you decided whether you are deciding whether to expand the capacity or buy it from the market, so in that situation whatever may be the additional cost of expanding capacity, that also you need to consider for decision making. But if there is an excess capacity available, so only those costs which can be avoided, like variable cost, that you can avoid it. Okay, so that you need to be considered. So we can take this example. An outside manufacturer approaches offset manufacturing and offers to sell the same at a 5 per unit. Okay, so here it is 5.5. Okay, offset has an excess capacity. They has an excess capacity. So the 10,000 factory floor supervisor salary is the only fixed cost that will be eliminated if offset the purchase. Okay, in fixed cost, the 10,000 you can avoid. Okay, so direct material. So avoidable cost is all variable cost, which is direct material 0.5, direct labor 2, avoidable cost. Okay. Why we are considering only avoidable cost? Because of excess capacity available. Okay. Direct material, direct labor, variable manufacturing overhead, yes, because you can avoid. Fixed factory overhead that you cannot avoid, but out of this, the 10,000 is a supervisor salary. Okay. So here, if you see like 10,000, 0.5, 40,000. So we are producing 20,000. So it is again 0.5. Okay. So that also you need to consider 0.5. 0.5 is basically the avoidable factory overhead. Factory overhead. Okay. So total cost is 3, 4. Okay. So if you are getting outside material for less than 4, then makes sense. So it is 4, difference is 1. So offset will choose to make the part because okay, what is basically, okay, they already gave a 5. They gave the price, buy price is a 5, so makes no sense. Okay, it should be less than 4. Okay, 5 is basically greater than 4. Okay, so you should not buy. Okay, it is better to manufacture internally. Okay, this we are not considering the fixed overhead here or the opportunity cost here because we are working with a some excess capacity available with us. Okay. Okay. In this situation, if there is no capacity available, the same example. Okay. So it is basically the 4 you need to consider, and I assume like the fixed factory overhead, which is avoidable, 0.5 it is given. Okay. Okay, it is an answer. Okay. So again, we need to incur the same additional expenses. Okay. So 4 plus 1.5. So we need to consider 5.5. So here the 5 is less. Okay. This situation we are discussing, this is basically the opportunity cost, because I need to increase the capacity, and for that I need to incur this expenses per unit. Okay. So again it is 5.5, which is greater than 5. So it is better to buy instead of go for increasing the capacity. Here, any doubt here? Then strategic factors, the following strategic factors should be considered when analyzing make or buy decisions. Okay, the same way, means these are some qualitative factors. The quality of the product purchased compared with the quality of the product manufactured. If you manufacture our own product, we definitely put focus on our quality, but the supplier may not focus on the quality. Okay, the reliability of the purchased product. See, reliability of the purchased product means whether he is delivered the product on a time or not, otherwise I may suffer a production losses. Okay, the value of service contract or other warranties, like whether he is giving a warranty or not, whatever may be the after sale service, that also we need to look into it. The risk associated with outsourcing or buying outside the organization, including inflexibility, loss of control, and less confidentiality. Second, what happened if I get it done some special products? So my know-how also goes to my supplier. So that is also the risk along with this whatever given here, or including inflexibility means we cannot push our supplier. Say for if I want to deliver fast, then maybe I'm okay to spend overtime. Overtime is generally a double the regular rate. Okay, but the supplier may not give the overtime to his employee. Okay, and he is trying to deliver the product on the basis of his comfort only. So these are basically the some risks. The most efficient use of the entity's resources. Okay, and how we are utilizing our resources. Okay, so these are basically the strategic factors. Any doubt here? Okay, then sell or process further. Okay, so joint cost. Okay, so whatever may be the common cost, okay, to produce output, that is basically the joint cost. Okay, generally it is like if the production in several stages. So stage 1, this will become an output for stage 2 or stage 2, stage 3, or process 1 and not stage 1, process 3. Okay, this is process 1. Okay, so what happened, whatever the cost incurred till now, that is basically the joint cost. Okay, and here we are manufacturing product X, and here we are manufacturing product Y. Okay, so this cost is basically the separable cost, because it is dedicatedly for the product X and this is dedicatedly for the product Y. But whatever may be the process 1 cost, it is for both product X as well as Y, so it is joint cost. So I hope you are able to understand the difference between joint cost and separable cost. So joint cost are the cost of single process that yield multiple product. Okay, so up to the separable point, and the separable costs are incurred after the split of point that can be traced to individual product. Okay, and that are relevant for the decision making. Okay, see, joint cost generally not relevant for the decision making because it is a common cost. Okay, and the separable cost split off. Separable cost we incurred after split off. Okay, so this is basically dedicated to particular product like product X, product Y, say for product Z. Okay, so you can identify this cost for against particular product like this. Okay, now factors or to sell or process further. Okay, so whatever may be the additional revenue that you are going to generate. See what happened for product X. Okay, up to joint cost. Okay, product Y. This give this we can produce with the additional cost of 20, and this will give the additional revenue of 10. Additional 10. Okay, do we need to product Y or we need to just produce product X and sell it? Any guess? See, if I manufacture the product X, I need to bear 100 rupees as a joint cost or the cost, and I'm able to get the sell value of 200. Okay, but if I further produce, then my cost is 120 and my revenue is 210. It is not an additional now. Okay, so what I need to do? Whether I need to produce product X and sell it, or I need to go further processing of product Y. Any guess? So it is simple now. Here the profit is 200 minus 100, 100, and here the profit is 210 minus 120, 90. Okay, so whether you are okay with the profit of 100 or you are okay with the profit of 90. So we should get the profit of 100. Okay, so we should not produce further. Okay, so these are basically sell or process further. Okay, so now we can take this as an example. Jackson Inc. processes raw material into beauty product. The soap division process fats and lay at a cost of $200 per batch, which yield 2000 bar of soap. Soap can sell the soap for 0.50 per bar at this point. Okay, so sell is 0.5. Okay, and the cost is $200 per batch of 2000 bar. So it is maybe the 0.1. Yeah. Okay. Now, at this alternatively, various fragrances and oil can be added to the product for fine soap for the high-end retail market from given batch of raw material. Soap could incur additional cost of 1.2. It is 1.2 additional. So now the total is 1.3. Okay. An attractive packaging and creates a scented soap, or for an additional cost of 1 point per soap could create a rose scented soap. Okay, so there is one more. So this 1.85. The high-end soap will sell at 1.30 per bar, and the lavender scent and $3 per bar for the rose scent. Okay, so here the sell price is for first one, it is 1.75, and the second one it is 3. Okay, so in first scenario, second scenario, third scenario. Okay, so first we will consider only additional cost. Okay, so additional cost for second is basically 1.2, which gives the revenue of 1.75, and in case of a third it is 1.3. Okay, and in case sell at 1.3, and in case of a second, additional cost is 1.75, which gives the value of 3. So here if you see, here the 0.1 is the profit, and here the profit is 1.25. Okay, so it is better lavender soap because the cost after the split off is 1.2 per bar and incremental revenue is only 0.8. Okay, minus 0.50 basic soap. So incremental revenue is less than the incremental cost. Okay, so 1.2 and the incremental revenue is 1.3 means already 0.5. Okay, that also we need to consider. We have not considered this 0.5. So it is 0.8. So this is not the incremental revenue. This is 0.8, and here also 3 means 2.5 like this. So 0.8 means it is minus 0.4, and 2.5 minus 1.75. So it is 0.75. So second option we need to reject because minus 4, and the third option is 0.75, which is a positive. So that we need to accept. Okay, so if the company decided to produce rose scented soap, the incremental costs are 1.75 per bar, and in the incremental revenue is 2.5 per bar. Because the incremental revenue exceed incremental soap cost, soap would produce rose soap. Okay, it is like this. Okay, so what happened means we will take once again. The original cost is basically 0.5, 0.1 sell, and the cost. Okay, in second case additional cost is 1.2, that we can sell at a whenever we incurred additional cost we can sell at a 1.3. Earlier the sell price is 0.5, so incremental revenue is basically the 0.8. In the third case, if I incurred additional cost of 1.75, I can sell at a 3. So 0.5 is original sale value. So incremental revenue is 2.5. And now I am going to calculate the profit. So here 0.4 means that we need to get it. And here it is basically the minus 0.4. Okay. So if I sell this, then I am losing this profit as well. Okay. And here it is 0.75. So which will give the additional profit. Along with 0.4 original one. Okay, so this way I need to decide, okay, I can continue with this, but this 0.2 we need to we cannot produce it. Okay, so that is basically the whenever we are whenever we are going to take a decision whether we need to sell as it is or we need to process further. So if this option is not available, then we can go with this, but at any cost we cannot select this one. Any doubt till now? Okay, now keep or drag a segment. Okay, so what happened? I have a unit 1, unit 2. Okay, so here what happened? Like my sales 1000, variable cost 700, fixed cost 200, and the profit 100. Okay, in unit 2 my sales is 200. Okay, variable cost is 100, fixed cost is again 200. Okay, so what is my profit? It is minus 100. Okay, in that situation, if I ask you whether we need to close the, because it gives the losses, so whether we need to close unit 2 so that we can earn 100 as a profit. Any guess? So, no technicality involved here. It is just a commercial mindset. If you combine this, it is 1200, 800, 400. So there is a zero profit. And I want to, I mean, if I think, okay, I need to earn the 100, so it is better to close down. What is your view? Any guess? Today, everyone is silent, means like it is too fast or what? Okay. So see, whenever you are evaluating like this, keep in mind all fixed cost you need to absorb whether unit is continue or not. Okay. So in that situation, if you discontinue this, okay, so your profitability is basically 100, variable cost, 1000, variable cost is 700, fixed cost is 2000 plus this 2000, so it is 400. Okay, so if you close down the unit, then it is with the minus 100. Means what I'm doing here, I'm comparing with this. Okay, instead of 1200, it is 1000. Instead of 800, it is 700. But instead of 400, it is all 400. So if I discontinue unit 2, then I am going to incur a loss of again 100 instead of 0. So unless and until variable cost is less than sell value and the fixed cost is unavoidable, okay, you need to consider, you need to operate if there is a contribution margin. Okay, if the situation is like that, ki out of this 200, you can avoid 100. Okay, so in that situation, it is basically the 1000, 700 and 300. So again, it is more than the same. Earlier also it is 0 and now also. But if it is instead of 200, you can avoid 150. So it is basically the 250 and then you are able to earn the profit. Okay. So this way you need to decide whether you need to keep the segment or drop a segment. Okay. If you want to drop a segment, then first whatever may be the avoidable cost that you need to compare with our means whatever the revenue you are going to forego. Okay. So if you close the division, the revenue you need to forego and whatever the cost you can avoid, that you need to consider and then evaluate whether you are getting a profit or not. So we can see here the executive at Covard Industries are evaluating each of their product line. A variable costing analysis by the product shows that the company's CAM and co-order products are profitable, but its co-order product is not. Okay, this one is not profitable. Okay, fixed costs are unavoidable, so entire fixed cost is not avoidable. So if you see the contribution margin is less than fixed cost, okay, So sorry, variable cost is less than sell price. So you are able to generate some contribution margin. So you cannot drop the this division. Okay. See, I'll show you here. I mean, just compare this total. Okay, if I drop knock division, okay, and consider only calm and con, okay, so how much my sales? 1,75,000. Then variable cost 90 plus 25, so it is 1,15,000. Okay, my contribution margin is 60,000. Fixed cost I need to consider entire, which is again 60,000. Okay, so the profit is 0. Whereas when I continuing with this division, I am able to generate the profit of 15,000. That is possible because I am generating some contribution margin to offset this fixed cost. Okay, so that's why I cannot discontinue this division even though it is in loss. Okay, so here the profit is 0. The knock corner product line should not be eliminated. Elimination of the product would eliminate the company-wide profit because the product makes a positive contribution to covering the entity's fixed cost. If some fixed costs are avoidable, so that also you need to consider. Okay, so here assume that the 16,000 of knock crowder fixed costs are avoidable. Okay, so in that situation, so what happened? 170, it is again 60,000 plus, instead of entire 16,000 60,000, 16,000 is avoidable. So 20 20 20 60,000 minus 16,000 that we can avoid, so it is basically the 44,000. So you are able to generate the profit of 16,000. Yeah, so 16,000 is basically, because in that situation your avoidable fixed cost is 4,000 only. So like if you see here, all are 2020, the only this is here 16,000 is avoidable, so that's why we eliminated. So we are able to get the 16,000 additional profit. Okay, so in earlier case it is 15,000, but now it is 16,000. So discontinue of this division is avoidable, advisable. So the coder head executive should eliminate the knock coder product line because the avoidable fixed cost exceed the contribution margin, that is loss when the product is eliminated. Okay, so in this case, elimination of the knock coder product line improves overall productivity from 15,000 to 16,000. Then the strategic factors. So if the products are complementary, then it is difficult to dispose. Okay, because what happened, if you are because if you are offering a combined solution, okay, it makes sense and the customer may buy it. Otherwise, because of elimination of one division, it may affect the sale revenue of the other division. Okay, so that you need to consider the impact of product addition or deletion on the employee morale. Okay, because if you close down the division, then the other employees of the other division may also get suffered. The growth potential of each product regardless of individual profitability. Means maybe today we are not able to generate the margin for a particular division, but growth potential is very high than the other product line, and the opportunity cost associated with the available capacity. If you cannot utilize that capacity for other purpose, then also you need to consider that. We already generally consider because it is an unavoidable fixed cost. Okay, in that way we are going to consider it. Okay, any doubt here? Okay, so just give me 5 minutes. I will send the question answer on your WhatsApp so that we can start to solve that. I'm just waiting to open my WhatsApp. I'll send it to you in 5 minutes. Okay, so can you see the screen?
Yes, sir.
Yeah, okay. So we can solve one by one. The first question. I already sent the Word file on WhatsApp group. Any guess? Okay, whether we are using net income or net cash flow? First question. If you're not giving an answer, how could I understand whether you are means whatever I thought, whether you are understood or not?
The cash flow.
Yeah, cash flow, correct. Okay, so means you know the outflow which is 450,000. Okay, now you need to calculate the present value of inflow. So as you says net cash inflow, so it is 150,000. Now you need to discount it for all 5 years. Okay, so it is not the case only for last year. So you need to multiply 150,000 multiplied by 4.212. So 1,50,000 multiplied by 4.212. So this is my present value of the cash inflow. Okay,
The
so
D.
which is 631.
D.
Yeah, D is the right answer. 181,800. Second question.
what's your but joint manufacturing?
Sorry?
The I joint.
Like out of this five, all or which one? Okay, so here actually the option should be 1, 2, 1, 2, 3, 1, 2, 3, 4, 5. So just select okay, whether we are going to consider selling price per pound of X547 for this decision making. So here see what happened. Selling price per pound of X547 and the selling price per pound of xylene. If we consider both, then we can calculate the incremental revenue. So first and fourth we need to consider variable manufacturing cost of upgrade process, that also we need to consider. Avoidable fixed cost also we need to consider. Only the joint manufacturing cost that we do not require to consider. So it is for 1, 2, 3, 4. Options are not given by mistake. Okay, question number 3.
Sir,
Which one?
sir, this PDF you have not sent in our WhatsApp group. I think you have sent it in the other one.
Just a minute. This one. Okay, it is not reached to you because of some. Okay, so it is. No, I'm sending a proper WhatsApp group, but it shows delay in delivery actually.
Okay, sir.
Okay, so it reaches to you.
Not our with PG US CPA Course.
Yeah, no, I send it to proper WhatsApp group. Yeah, now it is sent.
No, sir, this is wrong group. Our batch is PG
Just a minute.
US CPA 24 minus 26. PG.
Okay, it is
Give
this one,
them this
this one,
part.
this one.
Yes,
Okay, understood. I'll set one up. Hmm? Yeah. So question number 3. Any guess?
C.
C. See why we go with the just in time, because storage of inventory does not add value, so we avoid that cost. Setup time is reduced, that avoid the cost. Supplies arrive at regular interval throughout the production day, that also okay. or it is not basically cost for us. Employee with multiple skill are used with the greater efficiency, that also okay. But inventory is not giving any value addition to the production process. It is lying in our store only. So that's why we need to use the concept of just in time. C is the right answer. Question number 4.
The treasury bill.
Yeah, so it is basically mean return divided by standard deviation, and then you need to calculate. So US Treasury bill is the right answer. Which of the following characteristics of short-term financing for a company to meet capitalization needs? Question number 5.
I'm not sure, but A.
A. An increased interest rate risk to the borrower. Question number 6. PEG ratio is basically PEG equals to price divided by earning multiplied by growth rate.
For B. Yeah.
B. So it is
So 4 multiplied by 2.5.
4 multiplied
Yes.
by 2.5.
Yeah.
Growth is 2, but then you need to multiply the earning per share as well, plus growth rate. So it is 11.25. Sorry, 10.25. This will be the answer.
10.25. So
Yeah. So it is 4 multiplied by 2.5 multiplied by 10.25. Four multiplied by 10.25 multiplied by 2.5. 102.5. So it is, means you can use the 102. Question number 6. Sorry, question number 7.
sir, A.
A. Yeah. Question number 8. residual income is EVA is basically expectation, and the residual income is basically, I mean, the net income divided by the expectation, and the residual income is net income minus cost of capital. Net income minus cost of capital.
So the B,
C,
income component higher than PV.
no, C is the right answer. See, again keep in mind, EVA and residual income. Okay, in EVA, net income minus cost of capital, or not cost of capital, expected return. Okay, and the residual income is net income minus cost of capital. Okay, so what happened? If EVA is more than residual income, that means the EVA is more than residual income. That means the cost of capital is less than expected return. Hurdle rate. So cost of capital is less than hurdle rate. So just imagine, I mean, if I put in a numbers, so it is expected return, maybe the 12% and the cost of capital is 10%. The investment is 1 lakh. So 12%, 12,000 and 10,000, and my net income is 20,000. So here 20,000 minus 12,000. So it is 8,000, and here the 20,000 minus 10,000. So it is 10,000. Higher than the residual income, so cost of capital should be more. Cost of capital is greater than the hurdle rate, like this. So A could be the answer.
So can you explain again?
Yeah, just a minute. Okay, understood. The cost of capital, so discounted rate. Okay, no, it is not like this 10,000 or 12,000. Okay, so if I mean the formula is correct, okay, but it is not like this. Okay, if I discount at a higher rate, okay, so then this amount will be less, means the net income will be less. Okay, say for 20,000, 50,000, 70,000. I'll consider the 3-year only. Okay, my expected return. Okay, so then multiply 12%. So 1 divided by 1.12. So this is 10,000, 1,07,541. And if I applied the cost of capital, then it is so in cost of capital you will get the higher amount. Okay. So net income is say for 2 lakh. So 2 lakh minus 1 lakh. This is okay. 92,000, and then by Okay, but here if you see the hurdle rate, the amount is less, so you will get the more EVA than this cost of capital. Okay, so that's why the cost of capital is less than the hurdle rate. If the EVA is higher, so EVA is basically the return minus expected return, whatever may be the expected cost. Okay, so the cost of capital is less than the hurdle rate, then EVA is more than residual income. Residual income is basically, just keep in mind the formula, the net income minus cost of capital, and the EVA is basically the net income minus hurdle rate. Then question number 9.
Sir, B.
B, yeah, $100 decreases in taxes each year for 4 years. So, like the means you need to multiply with the addition of all 4-year discounting factor. So, B is the right answer. In first case, like you need to multiply with the addition of 3-year discounting factor, which is less than the B, and the disposal value at the end of the 4 years. So, only 1-year discounting factor you need to multiply. So, that is also less than the B, and it is a decrease. So, makes no sense. Okay, so we are going to stop here, and then tomorrow we will start from question number 10.